If you thought your favorite stores were safe, think again. Because the retail apocalypse is picking up speed, and by the end of 2025, America's shopping landscape might look unrecognizable. With over 50,000 closures looming and even iconic brands on the brink of extinction, the clock is ticking for some of the biggest names in retail. From cash burn to crumbling customer loyalty, these companies are spiraling toward disaster, and fast. If you've ever grabbed sneakers at Foot Locker, snagged deals at Big Lots, or swung by CVS for essentials, brace yourself, because they could all be gone before you know it. Today, we're diving into 15 of the most famous retail chains that are on life support, shedding stores, hemorrhaging cash, and fighting for survival. Let's find out if your favorite is on the chopping block. 15. Express. Express is in a troubling situation that is growing more dire by the day, and retail insiders are increasingly convinced this apparel chain may not last beyond 2025. Although it once captured the hearts of millennials and Gen Z consumers with its trendy designs and aspirational marketing, Express has suffered from a combination of waning brand loyalty, a fierce pricing environment, and an extremely competitive clothing market. According to UBS, over 50,000 stores in the US are on the chopping block right now, and Express's deteriorating sales, weakening margins, and growing operational challenges suggest it could be one of the next to go. On top of that, the company is dealing with a rise in e-commerce competition that has permanently changed people's shopping habits. Reports reveal that Express's online operations haven't kept up with top competitors, and failing to invest in better digital platforms at a time when consumers crave convenience has proven to be a major oversight. As foot traffic in malls plunges to historic lows and more consumers hunt for discounted fashions, Express's higher-priced, style-specific offerings are losing appeal. Several brand specialists argue that Express is now pigeonholed as a retailer of niche pieces that don't translate well into everyday wear, thus making it difficult to hold on to price-conscious shoppers seeking more versatile clothing options. Industry analysts also blame the lengthy overseas production lead times, which make it hard for Express to pivot quickly and ride fast-changing trends. With the chain often lagging behind the latest must-have styles, merchandise can hit the shelves when the initial hype has cooled. Moreover, management struggle to remain financially stable, due in large part to heavy debt loads and vendor hesitancy, only adds to this perfect storm. If things continue at their current pace, experts predict that Express may be forced to cease operations altogether as soon as 2025. 14. Kirkland's. Kirkland's has been a favorite among home decor enthusiasts for years, but the warning signs are becoming alarmingly loud, and many shoppers worry that 2025 might mark the final chapter for this once popular chain. For starters, the retailer's financial fundamentals have become increasingly shaky, with revenues dropping from over $630 million to under $560 million in just a handful of years. Analysts who track the chain's finances say that plunging foot traffic combined with weaker disposable incomes, especially during an economic downturn, are making it tough for Kirkland's to maintain profitability. Retail experts stress that consumer demand for durable goods like furniture and decorative items typically declines by 20% or more in a recessionary period, and that slowdown is hitting Kirkland's right where it hurts. Moreover, its stores face intense competition from online marketplaces, discount retailers, and big-box giants offering home decor at rock-bottom prices. Kirkland's historically relied on its attractive store environment to lure browsers into impulse buys, but in the digital age, not enough shoppers are coming into physical locations to see its signature displays. Adding to its woes, the chain's supply chain disruptions have led to scattered in-store inventory, frustrating customers who have grown accustomed to immediate availability. Seeking Alpha analysts have warned that if Kirkland's can't combat falling traffic and rising costs, its brand might go extinct by the time 2025 arrives. To make matters worse, the retailer's attempts to pivot with an e-commerce push have been slow and disorganized, leaving them far behind competitors that adopted digital-first strategies years ago. Increased overhead expenses, shrinking profit margins, and a looming threat of recession mean Kirkland's is now standing on unsteady ground. While some die-hard fans continue to flock to Kirkland's for seasonal decor staples, insiders caution that any further financial shocks could push the company over the edge, changing the home furnishings landscape forever. 13. Mattress firm. Mattress. Firm's days may be numbered, with industry authorities suggesting the retailer could soon vanish entirely from the U.S. market. After navigating a Chapter 11 filing in 2018, which resulted in the closure of hundreds of stores, the chain seemed poised for a rebound, only to face a brutal combination of declining demand, intensifying online competition, and skyrocketing operational costs. According to Bloomberg, major suppliers in the mattress and bedding segment are also under severe pressure, and if key manufacturing partners collapse, mattress firms' supply chain could disintegrate practically overnight. That risk alone puts the retailer in a perilous position as it struggles to maintain store operations and meet customer needs. Retail analysts note that the bedding market is notoriously cyclical. When consumer confidence dwindles in a downturn, big-ticket items like mattresses are among the first purchases to be postponed. With inflation taking a bite out of household budgets, shoppers are downsizing purchases and stretching out usage of their existing mattresses, resulting in plunging sales for specialty retailers. Worse yet, the proliferation of direct-to-consumer mattress startups, many of which operate primarily online and bypass the overhead of physical stores, has created an environment where mattress firms' pricing can't keep up. Insiders say these online-only brands can undercut traditional stores by as much as 30%, which is pulling bargain-hungry Americans away from walking into mattress firm locations. Meanwhile, the chain is burdened by expensive leases at high-visibility retail sites, a legacy of the aggressive expansion strategy it pursued several years ago. Now that foot traffic is falling and numerous shops are barely breaking even, the cost of keeping them open could become an untenable burden. Some experts suspect that if the economy doesn't turn around soon, or if financing tightens further, mattress firm won't have the resources to stick it out through 2025, ultimately vanishing in a wave of bankruptcies that are reshaping the retail industry. 12. Corner Bakery. Corner Bakery, once hailed as a charming, fast-casual cafe chain serving soups, salads, sandwiches, breakfast items, and baked goods, is teetering on the brink of total collapse. Once boasting a footprint of over 200 units nationwide, recent data suggests the number of operating locations has dropped to around 125, and that decline shows no sign of slowing before we reach 2025. The brand's broad menu, while appealing in theory, has left it struggling to stand out in a crowded segment dominated by specialty restaurants and artisanal bistros offering more distinctive, on-trend menus. Consumers are increasingly seeking unique dining experiences and healthier, more curated options, making it tough for Corner Bakery's generalized menu to generate the kind of excitement needed to pull in foot traffic. Moreover, the company has racked up an enormous debt load over the years. Reports peg it at around $33.8 million. This borrowing stems from a series of expansions and acquisitions that never truly paid off, and new ownership inherited this financial baggage at a time when the restaurant sector was already reeling from pandemic-induced disruptions. Even after dining rooms reopened, many Corner Bakery locations struggled to lure customers back, particularly in urban areas where office workers shifted to remote or hybrid schedules. The chain tried to adapt with expanded takeout and delivery options, but it didn't gain enough momentum to recover lost sales. Now, after filing for Chapter 11 protection, Corner Bakery is desperately seeking a buyer to swoop in and rescue the brand. Unfortunately, potential investors are wary of the chain's outdated ambiance and mounting debt, making a successful turnaround look less likely every day. Experts say that given the speed at which the casual dining market is evolving, Corner Bakery's fate might be sealed. If a major investor doesn't step up soon, the chain may all but disappear from America's dining scene by 2025. 11. The Children's Place. The Children's Place is a once popular apparel retailer that rose to prominence by offering fashionable and budget-friendly clothing for kids. But the brand is losing ground in an environment where inflation, e-commerce competition, and evolving consumer preferences are forcing dramatic changes across the sector. With the cost of living growing at the fastest pace in decades, many families are downsizing their apparel purchases, focusing on strictly necessary items rather than trendy additions. The Children's Place has already shuttered over half of its physical footprint since 2020, going from more than 1,200 stores down to only about 530 as of early this year. Industry insiders project this brand could fade out entirely by 2025 if the trend persists. Analysts say that a combination of weak in-store traffic, rising operational costs, and stiff competition from giants like Target, Walmart, and Amazon, who all offer kids' clothing at competitive prices, has made it nearly impossible for the Children's Place to sustain profitability. According to recent reports, the retailer recorded a 10.2% drop in net sales and is grappling with mounting losses. Parents who once loved browsing through racks of cute outfits are now more inclined to place a quick online order or shop somewhere with a broader product range. Adding insult to injury, the Children's Place has frequently grappled with supply chain disruptions resulting in empty shelves and disgruntled shoppers. Worse yet, the brand has bet heavily on store expansions in certain markets that have not performed to expectations, leaving it tied to expensive long-term leases and overhead costs. Even an aggressive push into e-commerce has not delivered the turnaround leadership hoped for, as the children's apparel space online is flooded with discount-driven rivals. Unless the Children's Place can slash costs and reinvent itself fast, experts warn that the chain could be another victim of the retail meltdown by 2025. 10. Best Buy. Best Buy was once the premier destination for electronics, gadgets, and appliances, but its position at the top of the retail food chain is now precariously fragile. Industry observers point to the chain's waning store traffic and a wave of store closures that have occurred more quietly than those of some other big-box stores. Already, Best Buy has shuttered more than 80 locations since 2019, and insiders expect dozens more to disappear in the coming months as it fights to remain relevant in an electronics market dominated by e-commerce giants. Consumer electronics is one of the fastest-moving sectors, and Best Buy has struggled to keep pace with the speed of innovation, where new products quickly make older stock obsolete, resulting in profit-eroding markdowns. According to the company's leadership team, supply chain challenges and rising labor costs have squeezed margins even further, forcing them to rely on heavier promotional discounts to stay competitive. The shift in consumer habits, with more shoppers comparing prices online before making major electronics purchases, has put Best Buy at a disadvantage. In many cases, potential customers use the stores as mere showrooms to test products before ordering them at a lower price from an online competitor. Industry experts say that if Best Buy cannot reverse this showroom effect, it will continue bleeding market share. Alarmingly, a 2023 report from Moody's flagged Best Buy as a high-risk company if economic conditions deteriorate further. With inflation choking household budgets and an economic slowdown looming, discretionary spending on electronics could take a dramatic nosedive. The brand's attempt to expand into services like tech support and subscription models might not offset the crushing impact of stagnant revenue. If things don't improve quickly, Best Buy's leadership may have no choice but to keep trimming its real estate until the chain is nearly unrecognizable, or, by 2025, perhaps gone entirely. 9. Nordstrom. Nordstrom, once synonymous with luxury retail and excellent customer service, has found itself trapped in a downward spiral that's jeopardizing its survival. Although the retailer still attracts affluent clientele, it has suffered a shocking 40% sales collapse over the past 2 years, prompting mass store closures in both the US and Canada. Critics say Nordstrom's upscale model is losing traction in a market increasingly dominated by discount retailers and online powerhouses, especially as consumers remain wary about spending during economic turmoil. With foot traffic declining at a steady clip, those pristine Nordstrom floors are emptier than they've been in decades. Compounding the problem is the chain's massive overhead. Maintaining large, high-end stores in premium locations is wildly expensive, and those costs become unsustainable as sales continue to decline. While the company has attempted to rebrand with new concepts like Nordstrom Local and an expanded online presence, the pivot hasn't translated into the kind of revenue needed to maintain profitability. Analysts at Moody's have placed Nordstrom on a bankruptcy watch list, an alarming sign that the chain must act quickly if it wants to keep its doors open beyond 2025. Meanwhile, many of the brand's loyal shoppers are migrating to more competitively priced retailers during tough financial times, where sales abound and discount programs run year-round. Even high-income consumers are more budget-conscious these days, especially with inflation driving up costs in almost every other area of their lives. Nordstrom's leadership has indicated it plans additional streamlining measures and cost cuts, but rumors of more closures loom on the horizon. Industry veterans argue that department stores, in general, are facing an existential crisis, and Nordstrom is no exception. If the economic outlook darkens further, the brand's once sterling reputation may not be enough to save it from vanishing by 2025. 8. Amazon Go and Amazon Fresh. Although Amazon itself continues to be a dominating force in retail, its ambitious foray into physical grocery and convenience shopping, Amazon Go and Amazon Fresh, has proven far less robust. These two offshoots were launched with great fanfare, promising a futuristic, cashierless experience and an alternative to traditional supermarkets. But mounting evidence suggests Amazon is already pulling back on these formats, closing down multiple locations and halting the launch of new ones. Many industry watchers believe the company's lukewarm success in this segment means that by 2025, Amazon Go and Amazon Fresh may be mere footnotes in the e-commerce titan's history. Insiders say the main problem is that these stores never generated the volume of traffic or customer loyalty Amazon expected. The cashierless technology, while innovative, didn't always translate into seamless in-store experiences, especially for busy shoppers who found the concept confusing or simply preferred the human touch. At the same time, local groceries and discount supermarkets started doubling down on price advantages and loyalty programs, luring away cost-conscious families. Even in well-heeled urban centers, Amazon Go and Amazon Fresh struggled to consistently bring shoppers through their doors, and the overhead associated with maintaining sophisticated tracking systems and high-end equipment grew to be a financial burden. Additionally, inflationary pressures have forced Amazon to reassess all of its divisions, and executives concluded the high cost of expansion for physical grocery operations could not be justified if the returns remained mediocre. Instead, Amazon has shifted its focus to boosting Whole Foods, which has a more established clientele and an existing network of over 500 stores. This pivot leaves Amazon Go and Amazon Fresh out in the cold, prompting closures that have already begun in multiple states. By 2025, many experts believe both chains will be quietly phased out, reinforcing that even Amazon isn't invincible in the cutthroat grocery sector. 7. CVS. CVS, the pharmacy giant synonymous with personal care products and everyday essentials, is at a crossroads that may result in hundreds more store closures by 2025. Despite being a household name for prescription refills and last-minute health needs, CVS has been steadily shuttering stores over the past few years, a trend the company attributes to changing consumer behaviors and digital competition. Many Americans now rely on online pharmacies or big-box competitors to fill their prescriptions, and foot traffic in traditional drugstores has taken a nosedive. Meanwhile, the brand's attempts to diversify its offerings, adding everything from groceries to cosmetic products, haven't attracted enough loyal customers to offset slipping sales. Moreover, the structural issues facing CVS run deeper than just a shift in shopping habits. Many of its locations are in densely populated urban markets that have seen a sharp rise in rent and operating costs, making them increasingly expensive to keep open as profits shrink. Critics also claim that CVS's in-store shopping experience has grown outdated and unappealing, marked by empty shelves, an over-reliance on promotional signage, and a confusing store layout. In the face of stiffer competition from Walmart, Walgreens, and Amazon Pharmacy, CVS can't seem to differentiate itself enough to sustain growth. Industry veterans say a big piece of CVS's strategy, moving into healthcare services with in-store clinics, has not fully materialized in a manner that drives substantial foot traffic or revenue. At the same time, the company has struggled with supply chain bottlenecks, leading to shortages and stockouts that aggravate customers. CVS's CEO, Karen Lynch, announced plans to close at least 900 stores, but some analysts believe that might be just the beginning. With persistent economic turbulence and ongoing competition eroding its customer base, CVS's place in the retail landscape may shrink to a fraction of its former self, or vanish entirely by 2025. 6. Tuesday Morning. Tuesday Morning, best known for its off-price home goods and eclectic mix of seasonal decor, is in the midst of a painful decline that may result in the chain disappearing from the U.S. market by 2025. Having already filed for Chapter 11 bankruptcy protection twice, in 2020 and again in early 2023, the retailer has been forced to slash its store count dramatically. It entered this year with around 464 locations, only to announce the impending closure of 264 unprofitable stores. This drastic consolidation signals a rapidly shrinking presence that could signal the end for the once charming chain. In its heyday, Tuesday Morning capitalized on the treasure hunt shopping experience, drawing in customers who relished the thrill of discovering brand-name merchandise at steep discounts. But times have changed. A combination of pandemic-related disruptions, surging inflation, and a broader consumer pivot to online bargain hunting have left Tuesday Morning struggling to retain its former appeal. While the chain tried to revamp operations and store layouts to lure customers back, its attempts largely fell flat. Many longtime shoppers have switched to giant discounters like TJ Maxx, Ross, or Amazon, which offer an even wider array of products at consistently lower prices. Moreover, the company's supply chain management has been hampered by intermittent product shortages, leaving shelves half-stocked and customers disappointed. The frequent restructuring also eroded employee morale, leading to high turnover rates and inconsistent customer service. Despite efforts to streamline expenses, the chain's ballooning debt has become a major impediment to any real comeback. Retail analysts argue that without a complete overhaul and a significant capital infusion, Tuesday Morning will likely face ongoing declines. If economic conditions worsen or consumer spending tightens further, the chain could be forced into liquidation sooner rather than later, marking another casualty of the unforgiving retail environment looming over the next few years. 5. Dollar General. Dollar General once soared on the strength of its rock-bottom prices and convenient locations, carving out a niche as America's neighborhood general store. But a grim future now looms for the discount retailer as it struggles against mounting regulatory fines, spiraling operational costs, and a tarnished brand image that could accelerate its downfall before 2025. According to the U.S. Department of Labor, Dollar General has racked up more than $15 million in fines for health and safety violations since 2017, an astonishing figure that underscores how poorly it's managing critical compliance standards. These citations encompass everything from blocked exits to faulty storage procedures, endangering both employees and customers alike. Meanwhile, ballooning inflation is impacting Dollar General's target demographic, ironically making it harder for the chain to profit. Low-income shoppers, historically loyal to the brand, are tightening their belts even further, focusing on essential goods and bypassing the discretionary items that helped drive the chain's margins. Additionally, heightened labor costs are making it more expensive to staff each store, and a wave of negative publicity regarding the chain's working conditions has left many employees demoralized. In recent months, some stores have been forced to shutter because they were deemed too hazardous to continue operating. Retail experts warn that this company's rapid expansion strategy, opening new stores practically every day, may have stretched its resources dangerously thin, increasing the risk of bankruptcy if it can't rein in expenses and restructure. The overhead of so many locations is immense, and if the chain cannot fix ongoing safety issues promptly, further store closures and crippling fines will follow. Given the wave of store shutdowns popping up across multiple states this year alone, analysts predict more widespread closings on the horizon. If Dollar General doesn't right the ship soon, many say a full-scale retreat or complete collapse by 2025 remains a very real possibility. 4. Party City. Party City once seemed unstoppable, popping up in suburban strip malls as the go-to source for balloons, themed decorations, and all things celebratory. Yet, after grappling with a severe downturn in revenue, driven by inflated supply costs, evolving consumer habits, and the cataclysmic effects of reduced social gatherings, it found itself declaring bankruptcy at the start of 2023. Although the company had over 800 locations at one point, many are now liquidating inventory and shutting down entirely, signaling a demise few would have predicted a few years ago. Experts suggest that by 2025, the chain could very well be only a memory for party planners. The key blow came when lockdowns and safety restrictions forced families and friends to scale back in-person gatherings, leading to plunging demand for party supplies. Party City's management hoped that post-pandemic celebrations would bring a roaring comeback, but inflation and continued caution around large events stifled that rebound. Compounding these woes, the balloon supply, one of Party City's signature offerings, became both scarce and more expensive, further cutting into profits. In attempts to keep afloat, Party City tried introducing curbside pickup and expanding online offerings, yet they couldn't match the aggressive pricing of e-commerce rivals or discount stores. Longtime employees report a sense of frustration as corporate cost-cutting measures led to staff layoffs and bare-bones inventories, making the in-store experience far less appealing. The brand also faced stiff competition from craft store giants and big-box retailers that ramped up their party supply sections. Despite efforts to renegotiate leases and streamline operations, the debt load proved overwhelming, reaching the point where creditors demanded dramatic action. Now, as locations across the country are shuttered, many partygoers are left scrambling for alternative sources. Unless a miraculous turnaround occurs, the odds of seeing a fully revived Party City chain in 2025 are almost non-existent, marking yet another high-profile casualty of retail's unprecedented upheaval. 3. Foot Locker. If you're a sneakerhead who can't resist scoring the latest kicks and fresh streetwear, you might want to head to Foot Locker while it's still around, because retail analysts are increasingly convinced that this iconic athletic footwear chain won't survive the intense economic headwinds swirling through the market. Just like other legacy retailers, Foot Locker has been contending with declining foot traffic, competitive pricing pressures, and a heightened consumer shift to online purchasing. Shoppers nowadays can easily browse and compare prices among multiple e-commerce platforms. Over the past year, financial statements show that Foot Locker's in-store sales performance has been losing steam, particularly in its suburban mall locations, where foot traffic has dropped precipitously and rent remains stubbornly high. Compounding these challenges is the intense competition from direct-to-consumer channels offered by big-name sneaker brands like Nike and Adidas, which now sell their products directly to customers with compelling online experiences and exclusive releases. This shift in distribution strategy leaves Foot Locker in a precarious position because it no longer enjoys the same level of exclusivity or priority access to limited edition merchandise that once drew crowds. According to a recent earnings report, profits slipped by more than 30% year over year, and management hinted at further store closures as a necessary cost-saving measure. Moreover, looming economic turbulence has many consumers cutting back on non-essential purchases, including pricey sneaker splurges. With inflation taking a bite out of disposable incomes, experts say Foot Locker's margins could shrink even further, making it tough to stay afloat. If the trend continues into the next fiscal year, the brand could be forced to accelerate its restructuring or even shutter operations entirely. In other words, if you've been eyeing a particular pair of sneakers, now might be the time to snag them, because Foot Locker's future in the retail arena looks dangerously uncertain. 2. Rite Aid. Rite Aid, one of America's largest drugstore chains, has been steadily fading from the national retail landscape, prompting widespread speculation that it could disappear entirely by 2025. Over the past couple of years, the company has shuttered more than 145 underperforming locations, and it recently announced that over 100 more could go dark in the months ahead. Retail analysts say these closures reflect deeper systemic issues. Rite Aid has struggled to differentiate itself from bigger, better-funded competitors like Walgreens and CVS, all while navigating rising costs and diminishing in-store traffic. The chain's quarterly losses have been piling up, surpassing $67 million at the end of 2022, a figure that has forced executives to take drastic measures. According to CFO Matt Schroeder, there may be an opportunity to close more stores as management hunts for ways to slash overhead in an increasingly challenging environment. Part of the problem lies in Rite Aid's inability to meet consumers' growing preference for one-stop convenience. Whereas rivals have successfully integrated broader retail assortments or healthcare services, Rite Aid's product mix and store formats appear stuck in a bygone era. With foot traffic continuing to decline, it's no surprise the company has failed to keep pace with evolving consumer expectations. Further exacerbating Rite Aid's plight is the rapid expansion of online pharmacies, which are capitalizing on lower operational costs and digital convenience. As more shoppers adopt digital platforms for their prescriptions and health needs, traditional pharmacies like Rite Aid are left fighting for a shrinking pool of brick-and-mortar customers. Those who once strolled in for over-the-counter meds or impulse buys have turned to Amazon or grocery store pharmacies. Experts warn that if Rite Aid cannot execute a major restructuring, perhaps through mergers, acquisitions, or a complete revamp, it will likely become another casualty of the relentless retail upheaval by 2025. 1. Big Lots. Big Lots is the discount retailer that many bargain hunters once relied upon for everything from groceries and home goods to pet supplies and furniture, yet it now finds itself in a world of trouble. Despite operating over 1,400 stores in 48 states, the chain is grappling with declining sales, massive losses, and soaring overhead costs that are becoming untenable in today's unforgiving retail climate. Management recently reported that year-over-year sales are down 10%, and the company has been forced to shutter stores in urban centers to cut losses. According to financial statements, Big Lots ended its last fiscal year with a staggering net loss of over $210 million, a figure that has alarmed shareholders and prompted urgent internal restructuring. Worse still, Big Lots lost its largest furniture vendor in late 2022, eroding a key revenue stream for the retailer. Furniture has been one of the chain's core categories, and it frequently relied on discounted deals from suppliers to draw customers away from pricier home furnishing competitors. But with that partnership gone and foot traffic weakening, the chain's prospects appear dim. Retail experts suggest that Big Lots' reliance on heavily discounted merchandise has left profit margins razor thin. As inflation drives up the cost of goods and shipping, the retailer finds itself unable to pass on these higher expenses without alienating bargain-conscious shoppers. Company executives have candidly admitted that Big Lots burned through a large amount of cash last year, with no immediate signs of recovery. Many industry veterans believe that if the current economic turbulence persists, and if consumers remain wary of spending, Big Lots will have no choice but to downsize drastically or close its doors altogether. Some are even forecasting a Chapter 11 filing if conditions don't improve soon. By 2025, Big Lots may join the ranks of iconic chains that vanished forever in the wake of a relentless retail apocalypse. Thank you for watching.